Good morning, students. Let me check. Am I audible or not? Good morning, students. Let me check. Am I audible or not? Yes. Okay. In this session, we try to cover partnership accounts, very important chapter from our examination point of view. Look at everybody. Partnership accounts consist of 6 chapters actually. From these 6 chapters, the weightage given by ICAI is 15 to 20%. This is the weightage given by ICAI, 15 to 20%. Now, we check whether we are getting the same weightage or not in the examination. Look at, based on the 3 attempts, June 2024, September 2024 and January 2025, they have asked from partnership for 22 marks, 22 marks and 25 marks. On average, he is asking minimum to minimum 22 marks from these partnership accounts. And in which question the partnership accounts may be asked? If you observe, look at question number 3b, question number 3b, question number 3b is the place fixed by ICAI for partnership accounts. One question. After that, question number 4a, question number 4a. Okay, I will show you one more question paper also. This is September 2024 question paper. September 2024 question paper. Observe. Now here you can see this is 3A, non-manufacturing entity, 3B, admission of a partner. Is it clear? Next, 4A, retirement of a partner. This is how they are asking from partnership accounts. And I will show you recent question paper, that is January 2025 question paper also. Look at, this is 3A, non-manufacturing entities, 3B, capital ratio. 3B capital ratio, they have asked for 5 marks. This is from Introduction to Partnership Accounts chapter. Next one, 4A. 4A, they have asked a question from death of a partner. This is for 15 marks. This is for 15 marks. Yes sir, no students? Yes sir. 4A, 15 marks. Right. Now look at, we discuss the first and foremost chapter, that is Introduction to Partnership Accounts. Sir, from Introduction to Partnership Accounts, which type of problems they are asking? First, come to Introduction of Partnership Accounts. Introduction to Partnership Accounts. Which type of problems they are asking? First, they are asking preparation of profit and loss appropriation account. Preparation of profit and loss appropriation account. Second one, calculation of capital ratio. This is very important. Calculation of capital ratio. Third type of problem they are asking, guarantee of minimum profit. Guarantee of minimum profit. Next one they are asking, and this is also very important, past adjustments. Past adjustments. After closing the books of accounts, if any mistakes happened during the previous year, how can we adjust them? Through a journal entry. That is nothing but past adjustments. These are the 4 types of problems they are asking in the examination. Clear students? Now first we start discussing our profit and loss appropriation account. In case of sole proprietorship, the whole profit is distributed or the whole profit is transferred to the capital account of proprietor. But in case of partnership, the profit is distributed among partners now. So how this profit is appropriated among partners? To know that, we have to prepare one separate account called profit and loss appropriation account. Profit and loss appropriation account. This is extension to the profit and loss account. This is just an extension to profit and loss account. Clear students? Right. How the partners will share the profits? It depends on partnership agreement. Based on the partnership agreement, we distribute the profit to the partners. Sir, what the partnership agreement may provide? The partnership agreement may provide for salary to the partner, commission to the partner, or any interest on capital to the partners, or any interest on drawings charged from partners. okay, or any amount of reserve, some amount of profit may be transferred to the reserve. And after doing all these adjustments, and the remaining profit is called distributable profit to the partners, and this distributable profit may be distributed among partners in their profit sharing ratio, agreed profit sharing ratio. Is it clear? To discuss all these things, look at profit and loss appropriation account format. The trading account shows gross profit or gross loss. This gross profit or gross loss is taken to the profit and loss account. In the profit and loss account, we get net profit or net loss. This net profit is taken to the profit and loss appropriation account. Okay, look at by net profit transferred from profit and loss account. Now, salary to the partner becomes expense for business and income for the partner. But this salary we should not mix with the salaries paid to other employees. Do remember. And commission payable to the partner is also expense from business point of view or distribution to the partners, but this commission should not be mixed with the normal commission which is shown on the debit side of P&L account. Clear, students? Now observe. So debit side, to salary or commission or remuneration to partners. Sir, all partners are eligible for salary? No. Sometimes the partnership agreement may provide salary to all partners or salary to some partners. We have to see that who is eligible for receiving salary, who is eligible to receive commission, who is eligible to receive remuneration. That depends on problem to problem. Based on that, we prepare. Next, interest on capital. Interest on capital. Sir, how do we calculate interest on capital? Simple. How much capital they contributed, multiply with the rate of interest into time by 12. Right? So, to whom eligible? Sir, one partner eligible to receive interest on capital? No. All the partners are eligible to receive interest on capital. All the partners are eligible to receive interest on capital. Do remember. Next, reserves. Sir, how much amount we transfer to reserve? That depends on problem to problem. Sometimes the reserve amount may be transferred on the net profit. Whatever the net profit we have, on that net profit, some percentage we transfer to reserve. Or sometimes after doing all the adjustments, remaining amount distributed to partners as share of profit. Now, on that we calculate reserve. That depends on problem to problem again. Next, interest on drawings. Sir, how do we calculate interest on drawings? Sometimes interest on drawings directly given in the problem itself, or else we have to calculate. Now the difference is nothing but distributable profit. Look at, difference is nothing but distributable profit, and this distributable profit is distributed among partners as per their agreed ratio. Then what is the entry we got? Profit and loss appropriation account debit to partners capital account. And here partners may maintain their capital accounts under two methods. No? Partners may maintain their capital accounts under two methods. First one is fixed capital method. Second one is fluctuating capital method. If partners agreed to maintain fixed capital method, then they have to maintain two accounts for each partner. One is partners capital account, second one is partners current account. In this partners capital account, we record only capital contributed by the partner and any additional capital contributed by the partner and any amount withdrawn by the partner out of capital. Means the capital account balance will be fixed. The capital account balance is fixed till they contribute additional capital or they withdraw money from capital, out of capital. And all the remaining transactions between partnership business and partners. I repeat, all the transactions between partnership business and partners. Partnership business and partners are recorded in the other account, that is current account. Partners current account. What about fluctuating capital method, sir? In this, under fluctuating capital method, we maintain only one account for each partner. What is that? Partners capital account. All the transactions between partnership firm and business are recorded in this capital account only. Okay. So in the examination, we have to check whether partners are maintaining capitals under fixed capital method or under fluctuating capital method. Okay. Next. We try to solve one simple problem on the concept of preparation of profit and loss appropriation account. Observe carefully. Ram and Rahim start business with the capital of 50,000 and 30,000 on 1st January 2022. Rahim is entitled to salary. Who is entitled to salary? Rahim. How much? 400 per month. Here salary is expressed per month. We have to convert it into year. So 400 into 12 months. Interest is allowed on capitals and is charged on drawings at 6% per annum. Okay. Profits are to be distributed equally. How the profits are distributed? Equally after the above noted adjustments. Next, during the year, Rahim withdrew 8,000. Sorry, Ram withdrew 8,000 and Rahim withdrew 10,000. These are nothing but drawings. Next, the profit for the year before allowing for the terms of the partnership deed came to 30,000. What is the net profit? And this is the profit calculated in profit and loss account. Assuming the capitals be fixed. They said assuming the capitals be fixed. Means which capital method they are following? Fixed capital method. Clear? Prepare profit and loss appropriation account and the capital and current accounts relating to the partners. Here they are asking profit and loss appropriation account and capital account and current account. Two accounts for each partner. Means which method they are following? Fixed capital method. Clear, students? Now look at profit and loss appropriation account. How do we prepare? Whatever the profit we arrived in profit and loss account, that is first taken to the P&L appropriation account credit side. So by net profit 30,000. Now look at partnership agreement or partnership deed provides salary to Rahim. Now debit side to Rahim current account salary. At the same time we open Rahim current account. On the credit side we write 3,000 rupees salary. Sorry. Just a minute. Yeah. Rahim current account. Credit side salary 4,800. Next, what is the next one? On interest on capital. Interest on capital is allowed at 6% per annum. So 50,000 is the capital of Ram and 30,000 is the capital of Rahim. 50,000 plus 30,000, 80,000. 80,000 into 6%, 4,800 is the total interest on capital. Look at Ram current account, Rahim current account. Again we post the same two amounts on the credit side. Of current accounts. Next one, they said interest on drawings also charged at 6% per annum. Interest on drawings also charged at 6% per annum. But here to calculate interest on drawings, what we need? How do we calculate interest on drawings? Tell me, how much amount is withdrawn by Ram? Ram withdrawn 8,000 rupees. Rahim withdrawn 10,000 rupees. Rate of interest is 6%. Here also 6%. How do we calculate interest on drawings? Generally, interest on drawings is calculated from the date of withdrawing the amount to the date of closing the books of accounts. I repeat, from the date of withdrawing the amount to the date of closing the books of accounts. But here, the date of withdrawing is missing. They have not given the date of withdrawal. In that case, we calculate interest for an average period of 6 months. We calculate interest for an average period of 6 months. So 8,000 into 6, 8,000 into 6% into 6 by 12. How much it comes? It comes 240 rupees. 240 rupees for Ram. For Rahim, 10,000 into 6% into 6 by 12. It comes 300 rupees for Rahim. This is important calculation here. We have done all the adjustments. Now look at balance the account 30,000 plus 540, 30,540 minus debit side 4,800 plus 3,000 plus 1,800. It comes 9,600 minus 30,540. This gives 20,940. This becomes the distributable profit among partners. They said profit sharing ratio is equal, so that this 20,940 is distributed equally among each partner. Then what is the entry we record? Profit and loss appropriation account debit to partners current account. If we maintain fluctuating capital method, then we write partners capital account. Okay, look at profit transfer to Ram and Rahim. This is how we prepare profit and loss appropriation account. Sometimes there may be some disputes between partners. Whenever there is a dispute between partners, we have to check partnership deed first. If partnership deed is silent regarding any particular point, then we have to see partnership deed now. So here, when we refer the partnership deed, in some situations we refer the partnership deed. They are, look at here. Suppose if the partnership deed is silent, if the partnership deed is silent regarding interest on capital, if the partnership deed is silent regarding interest on capital, then no interest on capital is allowed to partner. No interest on capital is allowed to partners. Look at interest on capital. Problem is silent. Partnership deed is silent. But partners asking interest on capital. No partner is eligible to receive interest on capital. At the same time, no interest is charged on drawings. If we have any particular point in the partnership deed, we follow accordingly. Otherwise, we see partnership act. Next, salary or commission or remuneration. No partner is eligible. Generally, partners are owners. How can they say take salaries? But if the partnership deed provides, yes, this partner is eligible to receive salary. This partner is eligible to receive commission. If partnership deed says, okay, you can give. Otherwise, no partner is eligible to receive any salary. Okay, and no partner is eligible to receive interest on capital. At the same time, no partner is eligible to receive interest on, sorry, no part from no from the partners, we are not able to charge interest on drawings. At the same time, sharing of profit and losses. Suppose between two partners, there is no profit sharing ratio. Now they have a dispute regarding this. Some partner is asking more share. In that case, partnership deed, no profit sharing ratio. No, act says, partnership act says, okay, you people share the profits and losses equally. So sharing of profits and losses are to be shared equally. Next, interest on advance or loan by a partner to the firm. Sometimes, generally partners will provide capital to the business. Sometimes partners may lend money to the business. This is called advance taken by the firm from a partner. This is loan. Na? This is considered as loan or advance. On this, generally we allow some interest. If partners not agreed how much interest is payable to the partner, then we have to see partnership act. If it is written in the partnership deed that, okay, whenever the firm borrows money from partner, some 10% or 12% or 15% interest is payable. Yes, that is final. If there is no such provision, then we have to see the partnership act. Partnership act says interest is allowed, but at what percent? 6% per annum. Interest is allowed, but at what percent? 6% per annum is to be allowed on partners' loan to the firm. These are the provisions we have to remember. Next one. Next we discuss about capital ratio concept. That is very, very important. Capital ratio concept. Look at here, we have a problem. Yeah. Capital ratio, look at. Okay. Look at this example, capital ratio. Sir, what is this capital ratio? Sometimes the partners may share profits and losses in capital ratio. First of all, they agree to share profits and losses in a particular ratio. Or otherwise, they may agree to share profits and losses in capital ratio. Capital ratio means effective capital. Capital ratio means what? Effective capital. Sir, what is effective capital? Suppose partner introduced at the time of starting the business 1 lakh. If he kept this 1 lakh rupee for entire year, then effectively how much capital he kept per month? Totally 12 lakh rupee. 12 lakh rupee capital kept in a year. Every month how much capital he kept? 1 lakh. Like that, if we see 12 months now, so how much capital he kept in the business? 12 lakh capital he kept in the business. On this is nothing but effective capital. But sometimes partners, what they do, they may withdraw money. Na? They may withdraw some amount. Automatically their capital balance gets decreased. And again they bring some additional capital. So capital balance will increase. Again they withdraw money, capital balance will decrease. Like this during the year, what happens? There is no fixed capital. Na? There is no fixed capital. Capital is changing on timely basis. That's why what we have to do is, now we calculate effective capital. Based on that, we can share profits or losses to the partners. Look at how do we calculate effective ratio. A and B formed a partnership with a capital contribution of 50,000 and 30,000 respectively. This is the initial capital contributed on 1st January 2022. The profits were shared in the capital ratio. Capital ratio in the sense effective capital. Right. Calculate the capital ratio on the basis of following details. If nothing is introduced as additional capital, or if nothing is taken from the business, then automatically 50,000 and 30,000 becomes capital ratio 5:3. Yes or no? But during the year, if any additional capital is introduced or if any capital withdrawn, then automatically capital ratio will get changed. Look at capital introduced 31st March. Here capital introduced and it is capital withdrawn. Observe carefully. On 31st March, A introduced 5,000. 1st July, B introduced 9,000. 1st September, 5,500. 1st November, 4,500. First we see A. Observe total capital employed by A. First, how much capital he employed? 50,000. Next, on which date the capital is changed? From 1st January to 31st March, how much capital we have in the business? 50,000. This capital we have in the business for how many months? Sir, 3 months, sir. 3 months we have 50,000, 50,000, 50,000. So total product becomes 1,50,000 effectively. Next, his capital is changed from 31st March now. Yes, now his capital became 55,000. Initial capital contributed 50, now he contributed 5,000, total became 55,000. This 55,000 rupees is there in the business till what date? Till what date? Observe, he withdrawn amount on 1st July, 3,000 rupees. First look at A. He has withdrawn amount on 1st July. From 1st April to 1st July, how many months? April, May, June, 3 months again. Till 3 months, how much capital we have in the business? 55,000 rupees capital we have in the business for 3 months. So what is the product here? 1,65,000. 55,000 into 3. Next, his capital balance decreased from 55,000 to 52,000. So 52,000 is the capital. This capital is there in the business till what date? 1st September. Again 1st September he has contributed additional capital. From 1st July to 1st September, tell me, July, August, 2 months. For 2 months we have 52,000 rupees capital. Product is 1,04,000. Next, the same 52,000 rupees again changed. On which date? He has withdrawn 4,500. So 52,000 plus 5,500, 57,500 we have till how much? How many months? 2 months. From 1st September to 1st November. September, October. Again, he has withdrawn on 1st November 4,500. 57,500 minus 4,500, 53,000 rupees. Now we have capital. This capital we have in the business till what date? November, December, 2 months. Like that, calculate total product. 6,40,000 is the total product for A. Now look at B. B initially contributed 30,000. On which date this amount is changed? He has withdrawn on 31st March 2000. Means till 3 months we have 30,000 rupees balance. Product is 90,000. After that his capital balance gets decreased from 30,000 to 28,000. Next, he contributed amount on 1st July. Till 1st July, how much capital we have? 28,000. From 1st to April, May, June, 3 months we have capital of 28,000. Next, from 1st July, how much is his capital? 28 plus 9, 37,000. Sorry, 37,000. 37,000 is there till withdrawal of 1,000 rupees on 1st September. Means July, August, 2 months. 37,000 into 2 months. Next, he has withdrawn 1,000. Now capital decreased from 37,000 to 36,000. And this 36,000 is there in the business for how many months? 1st September, October, 2 months. Next, he has contributed additional capital. Just a minute. He has contributed additional capital 4,000. Now his capital became 40,000. And this 40,000 capital is there in the business for how many months? 2 months. Now what is effective capital? Look at 6,40,000 is to 4 lakhs. This is their effective capital ratio. In this ratio, we share profits and losses to the partners. Is it clear? This is very, very important concept in the first unit. Sometimes they may ask a question on this concept. Next one, past adjustments. Look at past adjustment. Yeah, illustration 5 is on the concept of effective capital, right? Now look at past adjustments. Just a minute. Yeah, look at in the recent RTP, they have given a concept on past adjustments. Past adjustments means what? Already last year profit, already last year books of accounts closed. Finally, the profit or loss is transferred to the partners. Already the last year books of accounts closed. Profits or losses are transferred to the partners. Okay, now in the next financial year, there may be some errors or there may be some mistakes happen out of the past years or something we forgot to record the transactions. Then how do we rectify those things? By adjusting capital accounts of partners. This is nothing but past adjustments. Or in the last year, suppose we may forgot to distribute some amount to the partners, maybe in the form of salary or maybe in the form of remuneration or any interest on capital or any interest on drawings, or the partners may decide from retrospective effectively from 2 years back we change our profit sharing ratio, or we take salary, or we take interest on capital, or we charge interest on drawings, like that they may think. Okay, now in that case how do we calculate the revised profit share between the partners? Through a through a one single entry, that is adjustment of past things through partners capital account. Okay, now look at Agarwal, Samuel and Khan are partners in a firm. Agarwal, Samuel and Khan are partners in a firm. On 1st April 2022, their fixed capital stood at 2.5 lakh, 1,25,000 and 1,25,000 respectively. What are their capitals? 2.5 lakh, 1,20,000 and 1,20,000. As per the provisions of the partnership deed, Khan was entitled to a salary of 25,000. All the partners were entitled to interest on capital at 5% per annum. Profits and losses were to be shared in the ratio of capitals of the partners. In the ratio of capitals of the partners. What is the capital ratio? 2.5 lakh, 1,25,000 and 1,25,000. These are the provisions are there in the partnership deed. Next, net profit for the year ended 31st March 2023 of rupees 1,65,000 and 31st March 2024 2,25,000. 2 years profit they are giving. 1,65,000 plus 2,25,000. Total becomes 3,90,000. Was divided equally. Without providing for the above adjustments. Means they are giving 2 years data. 31st March 2023 ending, how much profit we have? 1,65,000. Generally this profit we have to distribute among partners. How do we distribute? First, out of 1,65,000 we have to pay 25,000 rupees salary to Khan, and we have to deduct interest on capital, and the remaining amount we have to distribute among partners in their capital ratio. At the same time, 2024 profit how much? 2,25,000. Out of this 2,25,000, first we have to pay salary to Khan. After that, we have to provide interest on capital, and the remaining profit is distributed among partners in their capital ratio. This must be happen, but this was not happen. That is what they're saying. Instead of giving effect to the above three things, what they did? Simply they have distributed these 2 years profits equally. Now, because of this, some partners might get extra profit, some partners might get less profit. Yes or no? Yes, sir. Business profit will not affect. because 1,65,000 and 2,25,000, this is business profit. But partners, some partners may get extra credit, some partners may get less credit. Clear? Now, how do you adjust it? Simple. What we do first is, how the profits are distributed. First we take total profit is how much? 4 lakhs. How this 4 lakhs is, sorry, 3,90,000. How this 3,90,000 is distributed among partners equally? 3,90,000 divided by 3 equally means 1,30,000 is distributed to all partners. 1,30,000, 1,30,000, 1,30,000. Okay, this was credited earlier. This was credited earlier. Now we see actually how much amount we have to credit. Actually, how much amount we have to credit means 25,000 rupees salary I have to credit. This 1,30,000 already credit given, but actually how much amount we have to give credit to the partners, each partner? Agarwal, Samuel, Khan. Okay, Khan salary 25,000. He is entitled, I will tell you, one person, then remaining person you can visualize. Each partner is eligible to receive interest on capital. What is Khan capital here? Khan capital is 1,25,000. So he is eligible to receive 5% interest on capital. So this also we have to give credit. After giving all these effects, means Khan salary, interest on capital, remaining profit is distributed to all partners in which ratio? Capital ratio. What is capital ratio? 25, 250, 125, 125. Yes or no? That's it. In this ratio. In this ratio we have to distribute. You can simplify, no problem. After that we can see whether any partner is received extra credit or whether any partner received less credit or debit. This is how we have to do past adjustments. Very, very important. Okay, look at here. A, already how much amount credited? A, 1,30,000, 1,30,000, C, 1,30,000. Total 3,90,000. But amount which should have been credited? Amount which should have been credited actually. Khan salary 25,000. For 2 years now, 25,000 plus 25,000. 50,000 we have to give credit. Next, interest on capital for 2 years. Total capital is how much? Okay, 2.5 lakh for A into 5%. 25,000. 1 lakh 5% plus 5%. 10% for 2 years now. So 2.5 lakh into 10%. 1,25,000 into 10%. 1,25,000 into 10%. Total amount becomes 50,000. Clear? Right. So the profit is actually, first year profit is how much? Okay, both the years profit how much? 3,90,000. Both the years profits are 3,90,000. Out of that, we have deducted 50,000 towards salary and interest on capital 50,000. What's the remaining one? 2,90,000 is the remaining profit. This must be distributed in capital ratio. What is our capital ratio? 250, 125, 125. 25, 10, 25, 5, 25, 5. Again, 5 2 ja, 5 1 ja, 5 1 ja. 2 is to 1 is to 1. Look at 2,90,000 into 2 by 4. How much? 1,45,000. This much of profit we have to give credit. Next, 2,90,000 into 1 by 4. 72,500, 72,500. Actually, we have to credit this amount. 1,70,000 we have to give credit to A. 85,000 we have to give credit to B. Means here names they have given wrong. You can write Agarwal, Samuel, Khan. Agarwal, Samuel, Khan. Okay. 85,000 we have to give credit to Samuel. 1,35,000 we have to give credit to 1,35,000 we have to give credit to Khan. But how much given credit? Look at Mr. A got less credit. Mr. A got less credit. Samuel got more debit. Actually, we have to credit Samuel account how much? 85,000. But credited 1,30,000. Next, Khan, look at how much amount we have to give credit, 1,35,000. But how much credited? 1,30,000. Difference amount is nothing but 5,000. Now look at how do we record the entry. Mr. Samuel got extra credit now. Mr. Samuel got extra credit. Now you debit Samuel account for 45,000. Yes sir, Samuel current account debit. A got less credit. Now you credit 40,000. Khan also got less credit. Yes sir, now you credit with 5,000 rupees. This is the ultimate entry we have to record. Necessary journal entry will be Samuel current account, Agarwal current account and Khan current account. This is another important problem. Is it clear, students? Yes. Now come to valuation of goodwill. These many problems important from exam point of view. Okay, profit and loss appropriation account and capital ratio and this one past adjustments. Now come to treatment of goodwill in partnership accounts. Actually, this is a separate chapter. This is a separate chapter, but the valuation of goodwill concept we apply in either admission or retirement or death. Sometimes in case of admission of partner, retirement of partner or death of a partner, this one may be given as an adjustment. Right. Now, how do we value goodwill first of all? For valuation of goodwill, we have different methods now. First one, average profit basis, next super profit basis, next one capitalization basis and annuity basis. Average profit, super profit, capitalization and annuity basis. Out of them, most important one is average profit basis. Most of the problems they have given average profit basis for calculation for valuation of goodwill. Under average profit basis, how do we value goodwill? Generally, do remember goodwill is valued based on the past year profits. Goodwill is valued based on the past year's profits. Past year profits means how many years, sir? That may be given in the problem. That may be 3 years, 4 years, 5 years, or that may be 2 years. Minimum 3 years they give you. Based on these past profits, we value the goodwill. Okay. Now look at first, how do we calculate average profit? Average profit is nothing but total profit given. Just a minute. Total profit given for n number of years. Suppose 3 years profits given. 3 years profits you add. Divided by 3. You get average profit. You get average profit. This we call it as simple average. Suppose first year 10,000. Second year 5,000. Third year they have given 15,000. 3 years profits. Add. Total 30,000 divided by 3. How much we are getting? 10,000. This is our average profit. Next one, adjusted profit or future maintainable profit. Sometimes at the time of preparation of profit and loss account, goodwill is purely based on business profit. Do remember, goodwill is purely based on business profit. But at the time of preparation of financial statements or final accounts, P&L account, we take various expenses and various incomes, maybe not relating to business. Suppose interest on investments. Is it relating to business? Is it your business profit? No, sir. It is non-operating profit. Non-operating profit. If we have some building and we received rent, is it relating to your business? No, sir. It is non-operating income. Non-operating income. Now, abnormal loss of goods. Abnormal loss of goods. Because of abnormal loss of goods, the profit gets decreased. That year profit gets decreased, but this abnormal loss will not happen or will not arise in the future years. Na? In that case, that year profit decreased. Now that year profit you increase. So goodwill is purely based on operating profit. Goodwill is purely based on operating profit. Sometimes in the examination problems, they give you these type of things, which we need to adjust to the previous year profits. Is it clear? Suppose goods lost by fire. It's an abnormal loss. Every year goods will not get lost. Na? Okay. The year in which goods were lost, that year profit decreased. Now at the time of preparation of goodwill, you increase that year profit. That is called adjusted profit or future maintainable profit. Now look at. So how can we calculate goodwill under simple average? Tell me. Valuation of goodwill is equal to average profit into or future maintainable profit into number of years of purchase. What is number of years of purchase, sir? Yes, the same level of profit. So we have calculated average profit now. Yes, the same level of profit for how many years we get in the future. The same level of profit for how many years we get in the future. This is nothing but expected. Average profit is based on past year's profit. Now we are estimating that the same level of profit may be earned by the business in the next 2 years or next 3 years. That is nothing but number of years of purchase. Means next 3 to 4 years profits we are purchasing today itself. Why? Because the business has goodwill. Because of this goodwill, name and fame in the society, we get more profits than others. With this expectation, we purchase future years profits. Right. Next, weighted average profit basis. But here they said, if we have any clear increasing or decreasing trend, I repeat, if we have any clear increasing or decreasing trend, then we follow weighted average profit basis. So weighted average profit basis means what? Yes, suppose continuously the profits are increasing. Continuously the profits are increasing or continuously the profits are decreasing. In that case, we assign weights for the profits. Then we calculate weighted average profit. Weighted average profit. In that case, we have to prepare one statement. But in the examination problems, even though there is a clear trend of increasing or decreasing, they have followed simple average profit. They have followed simple average profit. Okay, that's why most of the cases we follow simple average profit. Why, sir? It is simple. No need to prepare any table for calculation of weighted average profit, all those things. Okay, now look at the following table is prepared. Here, profit, weight. Weight is assigned from 1 to 1, 2, 3, 4, like that, consecutive numbers. Okay, and weighted profit. Suppose let us take this is year, profit, weight. Then how do we get weighted profit? 2 into 3. How we get weighted profit? 2 into 3. Clear? Now, this weighted profit total is taken for valuation of goodwill purpose. Then what is the formula for valuation of goodwill? Tell me. Weighted average profit is equal to total weighted profit divided by number of years total of weights. Nothing but sum of 4 divided by sum of 3. To put it simple, sum of 4th column divided by sum of 3rd column. Clear? Then we get weighted average profit. Goodwill formula, weighted average profit into number of years of purchase. Number of years of purchase. Next, straight away now I am going to admission of a partner, because here I am discussing the important point from examination point of view. Here I am not discussing super profit basis, capitalization basis, annuity basis. No. From examination point of view, in admission, retirement, death, they are asking majority of times average profit. That's why I have discussed average profits. Next, come to admission of a partner. Very, very important. From this, admission, retirement, death, dissolution. These 4 chapters are very, very important chapters, students. Right. Now look at admission of a partner. Sir, what is the meaning of admission of a partner? Whenever, suppose two persons they are doing business. When one person do business, then this is sole proprietorship. When 2 persons are doing business under the name of partnership, then we call it as partnership business. 2 people are doing business. Right. This is called partnership business. Right. Suppose if we add one more person, then total persons becomes 3 persons. Already 2 persons are doing partnership business, and they added one more person, then total partners becomes 3. This situation is called admission of a partner. That means new person is admitted into our business as a partner. In that case, what is the accounting treatment? Sir, whenever a new partner is added, sir, we give some party and we arrange some room for him. We arrange some nice table, okay, nice cabin, AC, all those things. Okay, forget about them. We are not discussing about those things. we have to discuss about whenever a new partner is admitted into the business, then how the books of accounts gets affected. Because we are accountants, we have to see how the books of accounts gets affected. Is it clear, students? Yes, sir. Now observe carefully. Okay, just a minute. Yes, look at here we have trading account, we have prepared profit and loss account, and profit and loss appropriation account. Then after we prepare balance sheet. Let us assume this is for the year 2023-25. Sorry, 23-24. Observe carefully. Generally, on which date the partner is admitted? Generally, the partner may be admitted from the beginning of the new financial year. Why, sir? Anyway, at the end of the financial year, we complete all the books of accounts. We close the books of accounts and we prepare, we prepare all the financial statements, trading account, profit and loss account, and balance sheet. Once final previous year books of accounts completed, now a new partner is entered into the business from the new financial year. If a partner is admitted during the year, a partner may be admitted during the year also, but if he admits during the year, then what happens? During the year, we have to adjust the books of accounts. It becomes little bit difficult. Generally, that's why in the examination problems also, to avoid all these confusions, they give you, but practically the partner may be admitted from any date. But in the examination problems, they give you from so and so date. Most probably at the beginning of the year, new partner is admitted. Okay. Before admission of new partner, what happens? Observe carefully. We have prepared the trading account, we have prepared profit and loss account, and we have prepared profit and loss appropriation account, and the profit is distributed to partners. And finally, we prepare the balance sheet. Now, you people tell me, balance sheet contains what? Balance sheet contains assets information and capital information and liability information. Sir, what about other accounts? Other accounts already got closed, na? How? By transferring to trading account, profit and loss account. Now, before the admission of partner, we have balance sheet alone. All nominal accounts gets closed. Now, whenever a partner is admitted in the business, he contribute capital, na? Capital account balance increase. Means capital increases. Okay. After admission of partner, capital increase. On the other hand, cash also increase. Very good. Sir, capital increase, cash increase, sir. Very good. Now he is owner. He has the right on assets. And he has obligation to pay liabilities because he is owner. Yes, sir. Now, at the time of recording assets, we might record the assets at low value. Sometimes the assets are shown at less than the market value. Sometimes the liabilities are shown at more values or less value, or sometimes we may forget to record any liability, and sometimes we may forget to record any asset, that may be fixed assets or current assets. Means the assets and liabilities values, the assets and liabilities value might be changed. Not all assets and liabilities, some assets and liabilities value might be revalued to show the actual position. Let us say, for example, we have building in the business. Building in the business. Generally, assets are recorded at historical cost. Suppose I have recorded building at, building is purchased for 10 lakhs. Now the building, before the admission of partner, the building market value is 50 lakh. The building market value is 50 lakh. After admission of partner, suppose the building is sold. How much amount we could realize? 50 lakh. We get 40 lakh rupee profit, and this profit is shared between all partners including new partner. Actually, this building was there in the business before admission of this partner. Now the building was sold. Why should we, the existing partners will think, na, why should I give this profit to the new partner? Because this building was there before his admission. Now we are selling, this profit we should enjoy. Like this, there are certain things in which we have to revalue the assets and liabilities. Apart from this, we have to do certain adjustments also. Like this, we have some 5 to 6 adjustments at the time of admission of partner. If you know the accounting treatment for these 5 to 6 adjustments at the time of admission of partner, the same adjustments are carried in case of retirement of partner or death of partner. Clear, students? Now we try to understand what are the various adjustments we have to do at the time of admission of a partner. Do remember adjustment and its accounting treatment. Adjustment and its accounting treatment. So before admission of a partner, which information they provide? They provide balance sheet. They provide balance sheet and some additional information. Before admission of partner, this is your balance sheet. Now, on some terms and conditions, this partner is admitted. The terms and conditions they provide. Is it clear? Now, by using this information, what you have to do? You have to do certain adjustments in the books of accounts, and we prepare a new balance sheet. And we prepare a new balance sheet after admission of partner. This is what we have to do in case of admission of a partner. Look at what are those adjustments. First one, revaluation of assets and reassessment of liabilities. If you do revaluation of assets and reassessment of liabilities, 50% of the problem completed. Next up, distribution of reserves and accumulated profits. The balance sheet contains the distribution undistributed profits and reserves. These undistributed profits are not distributed earlier. Yes, sir. Now, when a new partner admits, so he is also eligible to share out of this undistributed profit. That's why before admission of partner itself, the undistributed profits first we distribute to all partners, because these are the profits earned by these two people, old partners. Now here we call existing partners as old partners and new partner. New partner, right? So the undistributed reserves, reserves and undistributed profits are distributed to old partners. Sir, how we distribute? In their old profit sharing ratio. Old profit sharing ratio. After admission of new partner, we calculate new profit sharing ratio. Okay, so determining new profit sharing ratio, another adjustment. Earlier there are two partners, they are sharing profits and losses equally, 1:1. Now a new partner is admitted. Now what is the new profit sharing ratio between these three people? That we need to calculate. Next one, valuation of goodwill and its accounting treatment. Valuation of goodwill and its accounting treatment, very, very important. Here, in case of admission of a partner, the old partners will sacrifice their share. I repeat, in case of admission of a partner, the old partners or existing partners will sacrifice some share in favor of new partner. For their sacrifice, the new partner will compensate some amount, that is in the form of goodwill. This is from one angle. The second angle is the balance sheet contains various assets and liabilities. These may be fixed assets or current assets. Fixed assets, again, tangible, intangible. But the balance sheet may not contain one of the important intangible asset, that is goodwill. Till the admission of new partner, the old partners, they have did the business very well. They generated some goodwill. This goodwill is called self-generated goodwill. This goodwill is called self-generated goodwill. Before admission of partner, these partners, they did business, they got name and fame in the society. Now a new partner is coming into business, means he also enjoys that name and fame. By using this name and fame, the business gets more profits, and this new partner also enjoys share in the profits. Yes, sir. Yes. Now what we do is, at the time of admission of a partner, we also value the goodwill of the business. We also value the goodwill of the business. But this is self-generated goodwill. This is self-generated goodwill. After valuation of goodwill, out of this, the new partner share is contributed by the new partner either in cash or in kind. That accounting treatment we have to discuss. If you do goodwill adjustment and revaluation of assets and liabilities adjustment, then 60 to 70% problem completed. 60 to 70% problem completed. Is it clear? Next, last adjustment, adjustment of capital accounts of partners. Adjustment of capital accounts of partners means, before admission of new partner, the partner's capital may not be in accordance with their profit sharing ratio. Generally, in the business we have 1 lakh rupee total capital. There are two partners, they are sharing profits and losses equally. But the partners may contribute capital either in their either in their profit sharing ratio or in some agreed ratio. Suppose if A and B partners should bring capital in 1:1 ratio, means how much capital A should bring? 50,000. How much capital B should bring? 50,000. How much capital A should bring? 50,000. How much capital B should bring? 50,000. If A and B contribute capital like this, then it is said to be the capital of firm is in accordance with or in proportion to their profit sharing ratio. Maybe before admission of partner, the capital may not be in proportion to their profit sharing ratio. But after admission of new partner, all partners may agree that our capital must be in proportion to our profit sharing ratio. In that case, how do you give adjustment for this capital accounts? If you can solve these 5 adjustments now, but sir, in the examination, all the 5 adjustments given? No. First adjustment, guarantee, we have to revalue the assets and liabilities. Second, if you have any reserves and undistributed profits in the balance sheet, okay. Sometimes the balance sheet does not contain these reserves and accumulated profits. And sir, calculation of new profit sharing ratio and sacrificing ratio, is it necessary, sir? Yes. Sometimes you need not to calculate, they give you in the problem itself. Sir, valuation of goodwill you need not to do. Majority cases they give you goodwill directly, but accounting treatment you have to give. And in the problem, if they specifically give, yes, do adjustment for capital accounts of partners, then you do accordingly. Otherwise, ignore 5th adjustment. If you can solve like this, the admission of partner problem completed. Look at, for the first one, revaluation of assets and liabilities, what we do is, we create a new account called revaluation account. We create a new account called revaluation account. Revaluation account is debited. It is the nature of nominal account. Revaluation account debited with all decrease in the value of asset, increase in the value of liability. Revaluation account is credited with all increase in the value of asset and decrease in the value of liability. Sir, increase in the value of asset means profit, credit. Decrease in the value of liability, profit, credit. Increase in the value of liability, loss, debit. Decrease in the value of asset, loss, debit. Is it clear? So in that manner, we have to follow these entries. Look at first one. The following journal entries are recorded. First, increase in the value of asset or unrecorded asset is recorded now. Sometimes some assets are not recorded by the business. They maintain secret reserves or they maintain secret assets. they may be not recorded them in the books of accounts. Now they bring all those assets into books of accounts. In that case, what is the entry we record? Concerned asset account debit to revaluation account. Decrease in the value of asset means asset value gets decreased. Entry revaluation account debit to asset account. Next, increase in the value of a liability or unrecorded liability recorded now. Increase in the value of liability means liability value increases, credit. This is loss for us, debit revaluation account. Next, decrease in the value of a liability. Decrease in the value of a liability means liability decreased means you need not to pay. It's a gain for us. It is income for us indirectly. So liability account debit to revaluation account. Next one, profit on revaluation. Profit on revaluation. After passing first, second and third and fourth entries, now if you see the revaluation account, the revaluation account looks like this. Increase in the value of asset, unrecorded asset, decrease in the value of liability. Asset decrease, unrecorded liability, increase liability. Now this revaluation account is balanced. The balance in revaluation account is known as revaluation profit or revaluation loss. This revaluation profit or revaluation loss we distribute to partners. In which ratio, sir? Profit sharing ratio. To whom we distribute, sir? Old partners. To whom we distribute? Old partners. Is it clear, students? If it is profit, then what is the entry? Revaluation account debit to old partners capital account in their old profit sharing ratio. Loss on revaluation, old partners capital account debit to revaluation account. Once this is done, 50% of problem is completed. Is it clear? Right. So here look at important note point. Be careful about the language of adjustments. What? For example, there is a difference between machinery reduced by 25%. Suppose machinery value is 1 lakh. It is reduced by 20% means 25%. The new value is 75,000. New value of machine is 75,000. Suppose machinery reduced to 25% means 75% is depreciation, remaining 25,000 is the value of asset. So this language we have to take care about this language, right? Now next I will show you one problem. By solving problem, then we just a minute, then we can understand how to solve it. Look at illustration 1. We try to understand how a problem is solved. Approach, problem solving approach. Problem solving approach. Look at the following is the balance sheet of Ram and Mohan. The following is the balance sheet of Ram and Mohan who share profits in the ratio of 3:2. In the ratio of 3:2 as on 1st January 2022. Okay. Look at the liabilities and assets first. Trade payables, Ram's capital, Mohan capital. Fine. Building we have plant and machinery, inventories, trade receivables, bank. Anyway, bank balance will not change. Bank balance will not change. Then which assets will change other than bank and cash? On this date means 1st January 2022, Sham was admitted on the following. Sham was admitted on the following. Now, he is to pay 25,000 as his capital. Sham is bringing 25,000 rupees capital and 10,000 rupees as his share of goodwill. Okay, Sham is bringing 25,000 capital and also 10,000 goodwill for 1/5 share in profits. What is the profit? His profit 1/6. Okay, the new profits sharing ratio will be 5:3:2. The new profit sharing ratio will be 5:3:2. The assets are to be revalued and under. Look at how the assets gets changed. Building 25,000. Earlier, what is the building value? 18. Now building is increased by how much? 7,000. Next, plant and machinery how much? 12,000. Here plant and machinery existing value 15, but they revalued to 12,000. So there is a loss of 3,000. Yes, sir. Next, inventory value is how much? 12,000. Here inventory value 12,000. There is no change. There is no change. Trade receivable 9,500. Here how much? 10,000. Means 5,000 rupees, 500 rupees reduced now. They said this is due to doubtful debts. This is not due to bad debts. Do remember, this is not due to bad debts. This is due to doubtful debts. So at the time of showing debtors in the balance sheet, trade receivables 10,000 minus provision for doubtful debts 500, net amount 9,500. Net amount 9,500. Is it clear, students? Yes, sir. Next, it was found that there was a liability of 1500 for 1500 for goods received but not recorded in the books. So there was a liability for 1500, means new liability. Liability increased? Yes, sir. Give journal entries to record the above. Also give balance sheet of the partnership firm after Sham's admission. So journal entry, for which transaction we have to record journal entries? Look at, for the adjustments, means on which terms and conditions he admitted, we have to record the journal entry. Here use some common sense. First one, how do we record the entry for this? Okay, total how much amount he contributed? 25,000 plus 10,000, 35,000 rupees he contributed total. Then what is the entry we record? Bank account debit. Here bank account is there na? Bank account debit to Sham capital account 35,000. Bank account debit to Sham capital account 35,000. Okay, and he is bringing 10,000 rupees for his share of goodwill. Okay, goodwill is always distributed to old partners. Do remember, old partners, that too who sacrificed their share. I repeat, goodwill amount is always given to old partners, that too who sacrificed. To put it simple, goodwill is always given to the partners who sacrificed their profit share. Okay, now here we have to identify who are the sacrificing partners. Who are the sacrificing partners? For that purpose, calculate sacrificing ratio. Calculate sacrificing ratio. Total how many partners we have? Ram, Mohan. New partner anyway he will gain. Okay, Ram old ratio how much? Old profit share ratio. Take old profit sharing ratio 3/5, 2/5. Okay. Next we can take like this. Old, new. Ram, Mohan. Old ratio 3/5, 2/5. New ratio they have given, look at 5:3:2, means 5/10, 3/10. Now calculate sacrificing ratio formula. Old ratio minus new ratio. Here we get 10. 6 minus 5, so 1/10, 10. So 5 to z 4 minus 3 means 1/10. So what is sacrificing ratio? 1:1. This is how we have to calculate sacrificing ratio. First condition, tell me, goodwill is distributed to sacrificing partners. First condition. Second condition, then who are the sacrificing partners? Let me calculate. How do you calculate sacrificing ratio? Old profit sharing ratio minus new profit sharing ratio of old partners. Anyway, new partner always he gains. Always he gains. Sacrifice means, observe old partners. Sir, Ram and Mohan both are sacrificed? Yes. Sometimes one partner may sacrifice. Sometimes one partner may sacrifice. Do remember. Now look at 1:1 ratio. So how much is goodwill? 10,000. This is given to whom? Ram 5,000, Sham 5,000. Now what is the entry we record? That is the next question. In case of goodwill, ask 3 questions. First, how much is share of goodwill of new partner? How much is share of goodwill of new partner? Second, to whom the goodwill is distributed? Sacrificing partners. Calculate who are the sacrificing partners. After that, record the entry for goodwill distribution. What is the entry we record? Simple. New partner capital account debit. new partner capital account debit to sacrificing partners capital account. Sacrificing partners capital account. That's it. Over. Who is the new partner? Sham. Sham capital account debit 10,000. Who are the sacrificing partner? Ram and Mohan. To Ram capital account, to Mohan capital account. Over. That's it. Clear? The same entry they record. Sham capital account to Ram capital to Mohan capital. Goodwill is completed. Next is what? Assets revaluation. First, record the entry for one by one entry also you can record, or revaluation account debit, record one entry, revaluation account credit, record another entry. Here look at building value increased now, so building account debit to revaluation account. You can write the entry building account debit to revaluation account. Next, plant and machinery decreased now. You can write individual entries also, no problem. Revaluation account debit to plant and machinery account. Inventory value no change. Trade receivable value decreased to by 500. This is due to doubtful debts. Then what is the entry we record? Revaluation account debit to doubtful, provision for doubtful debts account. Next, it was found that there was a liability for 1500, unrecorded liability. So revaluation account debit to unrecorded liability 1500. Revaluation account debit to unrecorded liability 1500. Look at, or trade payables. This is for purchase of goods, na? This is for purchase of goods, trade receivable. Over 1500. After recording entries, now prepare revaluation account. Prepare revaluation account. If you prepare revaluation account, automatically you can come to know that whether it is revaluation profit or loss. Distribute that revaluation profit or loss to the partners. So in this problem, we have revaluation profit, revaluation account debit to Ram capital to Mohan capital. Working note, sacrificing ratio. Now, important thing is how to prepare balance sheet. How to prepare balance sheet. See, I will give you simple trick to prepare balance sheet. Simple trick to prepare balance sheet. Okay, look at, concentrate everybody. Concentrate. Now look at. First look at the balance sheet. By looking at old balance sheet, we have to prepare new balance sheet. I repeat, by looking at old balance sheet, we have to prepare new balance sheet. Yes or no? Yes, sir. Now look at old balance sheet, liability side, what item you have? Sir, trade payables. How much? 15,000. Does it changed? Yes, sir. It is increased by 1500. Okay. Go to new balance sheet. Go to new balance sheet. Write down 16,500. 15,000 plus 1500. It comes 16,500. Over, sir. Okay. Next. Ram capital, Mohan capital. I always suggest prepare a separate account. Prepare account. Ram capital account, Mohan capital account. Prepare partners capital account. In that case, Ram capital account credit balance, Mohan capital account credit balance. Over. Now come to building. Building. Is this building value changed? Yes, sir. How much? 18,000 plus increase by 7,000, sir. Write down the same in the new balance sheet. 18,000 plus 7,000. 25,000. Over. Next. Sir, plant and machinery 15,000. Look at whether it is is there any change? Yes, sir. It is decreased by 3,000. Okay. Go to new balance sheet. Write down same plant and machinery. Earlier value 15,000 minus 3,000 decreased. New value automatically 12,000. Next. Next asset is what? Inventory. Is there any change in the inventory? No, sir. Write down the amounts as it is. Next, trade receivable. Is there any change in the trade receivable? Yes, sir. What? Less provision. Write down in the new balance sheet. Same. Trade receivables 10,000 minus provision 500. Over. Next, bank balance. Is there any change in the bank balance? Yes, sir. Bank balance earlier 5,000. Now the new partner brought 35,000 rupees capital, sir. So total 40,000 bank balance, sir. Write down 40,000 bank balance. After completion of this, now go to partners capital account, working note. Partners capital accounts you balance, because here we have posted recorded entries, so posted them into partners capital accounts. Now balance partners capital accounts, and the closing balances of partners capital brought to the new balance sheet. closing balances of partners brought to the new balance sheet. With this, balance sheet gets completed. Suppose if you are not in a position to solve the whole problem, then at least solve 60 to 70% problem. But don't leave it. Don't leave it. Is it clear, everybody? Yes, sir. Now look at we solve illustration 2. Here, follow the technique. Follow, because tomorrow we have exam. Today it is not possible to discuss each and everything in detail. Here, I am here to help you how the questions are solved by using simple technique. Right? Now look at. Ultimately, what you have to do? You have to solve the question in the exam. That's it. Right? A and B are partners sharing profits and losses in the ratio of 3:2. A and B are partners sharing profits and losses in 3:2. Their balance sheet as on 31st March is given. First, observe the balance sheet. Trade payables, partners' capital accounts. Freehold premises, plant, furniture, office equipment, inventories, trade receivables, bank balance. Bank balance anyway gets changed with the introduction of capital or anything. And on the liability side, if you look at the reserves, like general reserve or any undistributed profit, immediately distribute these reserves to partners, whether they specify in the problem or not. Ignore, but immediately distribute general reserves and accumulated or undistributed profits to partners. Right? Now look at, this is the balance sheet we have. Now look at the adjustments. What they have given. On 1/4/2022, they admit C on the following terms. What are those terms? C will bring 50,000 capital. This is capital. In addition to that, he also bring some amount in goodwill. So 10,000 he is bringing for goodwill. And what is his profit share? 1/5. So total how much amount he is bringing? 60,000. Next, provision for doubtful debts is to be made on trade receivables 2%. Fine. Inventory to be written down by 10%. Fine. Freehold premises is to be revalued at 2,40,000, plant 35,000, furniture 25,000, office equipment 27,500. Almost all assets gets changed, na? These are 4 assets, and inventory also changed. On trade receivables, we are providing doubtful debts. Almost all assets gets changed. Next, very important point, 5th point. Partners agreed that the values of assets and liabilities remain the same. Means in problem number 1, illustration 1, here the asset values increased or decreased. The changed values we have shown in the balance sheet. But in this problem, all partners agreed that the assets and liabilities before admission of new partner, whatever the assets and liabilities values we have in the balance sheet, the same assets and liabilities value. Assets and liabilities in the sense only trade payables. Liabilities said trade payables, not capital. Capital accounts anyway change. Assets means except bank. See, not all assets except bank, remaining assets. Whatever the balances we have, they must be same. So then what is the necessity of preparing, doing revaluation? Yes. Their intention is we revalue the assets and liabilities. Finally, what is the outcome of revaluation of assets and liabilities? Either revaluation profit or revaluation loss. That effect we adjust through partners capital account. For that purpose, what we have to do is we have to prepare memorandum revaluation account. The memorandum revaluation account is prepared in 2 parts. Do remember. First part, similar to revaluation account. Second part, reversal of first part. Suppose in the first part I have increased asset value by 10,000. In the second part, asset value gets decreased. Here asset value increase. In the second part, the same amount of asset I am decreasing. Means if you visualize the asset account will not get changed. So then what is the importance of preparing this? Yes. In the first part, whatever the profit or loss we get, that is distributed to old partners in their old profit sharing ratio. In the second part, suppose in the first part we have profit, automatically second part becomes reversal na. In the second part we get loss. This loss we distribute to all partners in their profit sharing ratio. I repeat, this loss we distribute to all partners in their new profit sharing ratio. So what is the benefit? Yes, first part profit, to whom it is distributed? Old partners in their old profit sharing ratio. Second part, it is loss, it is distributed to all partners na. The difference between first part profit distribution, second profit loss distribution becomes gain for the new partner, becomes gain for the old partners. This you can observe only if you see the partner's capital account. If I say orally, you cannot imagine, but if you see partner's capital account, then you can visualize. Look at memorandum revaluation account here. Here asset value increase na. Look at, first we are increasing the assets, after that we are decreasing the assets and liabilities. Look at. Okay, now in the first part, what is the profit? 39,000 is the profit. 39,000 is the profit. And this is distributed to whom? A and B. How much to A? 23,400. How much to B? 15,600. In the second part, we got the same loss. But it is distributed to whom? All partners. Look at. A, B, C. First I have given credit to A, 23,400, B, 15,600. C, I am giving debit now, 18,720, 12,480, C, 7,800. Look at A, 23,400 credit, 23,400 minus 18,720 debit. So how much net credit? Net credit he got 4,680 net credit. B, look at 15,600 credit minus 12,480 debit, he got net credit 3,120. And this amount is equal to C. Look at C account debited. They have revalued the assets and liabilities. The effect is distributed to old partners and it is borne by new partner. If you observe the new balance sheet, if you observe, the assets and liabilities are at same values, no change except bank balance. And liability side, if you observe, the trade payables are same, no change, but capitals changed. Is it clear? This is the technique of solving this memorandum revaluation account. Then what about this goodwill distribution? Look at, we see goodwill distribution. How much goodwill we have to share? 10,000. Here they did not mention about new profit sharing ratio. Important point. He did not mention about new profit sharing ratio. Fine. Now this 10,000 rupees goodwill, to whom we have to distribute? Sacrificing partners. Who are the sacrificing partners, sir? A or B? If there is no new profit sharing ratio or there is no information regarding new profit sharing ratio, assume the old profit sharing ratio itself as sacrificing ratio. Assume the old profit sharing ratio itself as a sacrificing ratio. Means we have to distribute 10,000 rupees to A and B in 3:2 ratio, that is 6,000 and 4,000. Look at. What is the entry we record? C capital account debit to A capital to B capital. So to C capital, by C capital 6,000 and 4,000 goodwill. This is goodwill. Except this, there is no new thing. Look at 6,000, 6,000, 10,000. This is how we try to solve the answer. Next one, observe. Illustration 3, observe. See, each problem differently we are solving. First problem, revaluation. Second problem, memorandum revaluation. Look at, A and B are partners in a firm sharing profits and losses in the ratio of 3:2. The balance sheet of A and B as on 1/1/2022 was as follows. Look at first balance sheet. Trade payables, bank overdraft. Here asset side, building, furniture, inventories, same items almost. Capital accounts. Next, trade receivables. Already we have provision, investments and cash. Right. Very important is these adjustments. C was admitted to the firm on the above data. on the above date on the following terms. Look at the first term. C is admitted for 1/6 share in the future profits and to introduce a capital of 25,000. He is giving only the information of capital. He is not giving the information of goodwill till now. Okay. See, in case of admission, retirement, death, goodwill is 100% is there. Suppose if the goodwill information is missing in the problem, even though there is goodwill in the problem, that is hidden goodwill. That is hidden goodwill. Without goodwill concept, there is no concept of admission, retirement, death. Do remember. Simple fundamental rule. The new profit sharing ratio of A, B, C will be 3:2:1. Old profit sharing ratio given, new profit sharing ratio given. Now here you have to calculate sacrificing ratio. Here you have to calculate sacrificing ratio. C is unable to bring in cash for his share of goodwill. C is unable to bring in cash for his share of goodwill. That means he is not bringing cash. Okay, fine. They decide to calculate goodwill on the basis of C's share in the profits and the capital contribution made by him to the firm. Means what? C contributed how much share of capital? 25,000. He contributed for 1/6. He contributed for 1/6. 1/6. Now make it 100%. Make it full share. For 1/6 share, he contributed 25,000. Make it 100% share. For 100% share, how much is the total capital? Simple. 25,000 into reciprocal of his share. We get 25,000 into 6. Reciprocal, that we get 1,50,000. So 1,50,000 is the total capital. When he is bringing 25,000 for 1/6, then total capital how much? 1.5 lakh. Look at whether they have total capital 1.5 lakh or not. Observe carefully. So here their capital is 80,000. Actually in the firm their capital is 80,000. He brought 25,000 capital. Total capital must be how much? 1,05,000 only. 1,05,000 only total capital. But as per his calculation, how much he brought? 1.5 lakh. How much excess capital we have? 45,000. And this 45,000 is considered as goodwill of the firm. This is hidden goodwill. This 45,000 is considered as goodwill of the firm. Observe carefully. This goodwill calculation is very, very important. Calculation of goodwill. See, contribution 25,000 consists of 1/6 capital. Then total capital becomes how much? 1.5 lakh. How we arrived at this 1.5 lakh? 25,000 into reciprocal of his share. Then calculate original capital 1,05,000. What is the difference? 45,000. This is the total capital, total goodwill of the firm. Now what is the share of C? 1/6. What is the share of C? 1/6. Actually he has to bring 7,500 goodwill, but he is unable to bring. Yes sir. Even though we record the same entry. What is that entry? Goodwill adjustment entry. New partner capital account debit to sacrificing partner capital account. New partner brought how much? 25,000 credit. Now we are debiting his account how much? 7,500 debit. That's it. When he is not bringing separately for goodwill cash, then what we do? He is bringing 25,000 na. Out of that we take 7,500. Out of that we take 7,500. That's it. Remaining amount we consider as his capital. Anyway we take goodwill. Our goodwill we take. Clear? Next. Goodwill will be shared by A and B in their sacrificing ratio. What is sacrificing ratio? Look at A and B. Sacrificing ratio formula, old ratio minus new ratio, 3/6, 2/6. Old ratio, 3/5, 2/5. You can do this and you get here sacrificing ratio 3:2. And this 7,500 is distributed in 3:2 ratio. So what is the entry for that? A C capital account debit 7,500 to A capital to B capital. Hope you understood this. Yes. Next one. Furniture is to be written down by 870. Inventory to be depreciated by 5%. A provision is required for trade receivables at 5%. For bad debts, okay. A provision would also be made for outstanding wages of 1560. There might be some wages outstanding. For that we have to create provision. The value of building having appreciated be brought up to 29,200. The value of investments is increased by 450. The total fourth point is nothing but revaluation of assets and liabilities. It is found that the trade payables included a sum of 1400 which is not to be paid off. Here we have trade receivables now. How much trade receivables we have? 50,000. Out of them you need not to pay some 1400 rupees. Means it is a gain for us. Remaining amount we have to pay. Show the remaining amount in the balance sheet. The requirement is revaluation account and partners capital account. Understood? So revaluation account, look at if any asset increase, write down on the credit side. If any liability decrease, write down on the credit side. Debit side, if any asset decreased or any liability increase, write down on the debit side. Difference profit is transferred to the partners capital account. Clear everybody? Next, partners capital account. Here they have not asked any balance sheet. Next, look at reserves in the balance sheet. I said already, if you find any reserves and undistributed profits in the balance sheet, immediately, without any second thought, immediately distribute to partners. Immediately distribute to partners. Is it clear? Now look at. We try to solve one problem. Next we take some break. Then after we solve retirement, death and dissolution. Today I think our class will go to 1 o'clock also, because in the morning session we have to complete these partnership accounts. We try to complete. In the evening session we try to complete company accounts. Right? Here I am saying again, here I am giving only inputs to how to solve the problem to the extent possible. Maybe the whole problem is not solved, not possible to solve, but to the extent possible you can solve and come, you get good marks, believe me. Dalal, Banerjee and Malik. Dalal, Banerjee and Malik are partners in a firm, sharing profits and losses in the ratio of 2 to 1. Fine. Their balance sheet as on 31st March 2022 is as below. Look at the liability side first. Trade payables, outstanding liabilities, general reserve. Yes. Here they have given general reserve. Directly distribute this general reserve to old partners. In case of admission. In case of retirement, all partners. In case of death, all partners. Clear? Capital. These are the capital account balances. Prepare capital accounts separately. Then this becomes opening balances. Credit side. Dalal, buy balance B by D 12,000, Banerjee 12,000, Malik 5,000. Next, land and building, furniture, inventory, trade receivable, cash in hand, cash at bank. Here they have given two things, cash in hand, cash at bank. You can prepare cash account or cash at bank account by assuming. Automatically either one balance will get changed. The partners have agreed to take Mr. Mystery as new partner. Suppose if they ask balance sheet now, the same existing balance sheet copy paste. How sir? Trade payables, look at. If there is no change in the trade payables, write down the same amount in the balance sheet. Outstanding liabilities. If there is no change in the outstanding liabilities, write down the same in the balance sheet. General reserve. Anyway, general reserve we distribute. So that in the new balance sheet, there is no general reserve. And partners capital accounts, anyway we take closing capitals. These balances we have to take from capital accounts. Next, come to assets side, land and building. If there is no change in the land and building, write down the same in the balance sheet. Furniture. Yes sir, there is a change. Either increase or decrease and write down the new balance. Inventory. There is no change sir. Write down the same. Means by looking at the old balance sheet, you have to prepare new balance sheet. If there is any change, change it. Otherwise, write down as it is. Very simple. Admission problem, if you get admission problem now, you can get 10 to 15 marks. Suppose if it is given for 10 marks, at least you get 8 marks. Admission is easy. Retirement also, but when it comes to death, we have to be little bit careful. Now look at, the partners have agreed to take Mr. Mystery as partner with effect from 1st April 2022. Fine. Mr. Mystery shall bring 5,000 rupees towards capital. Okay. The value of inventory should be increased by 2,000. Now look at inventory 11,750 now. Increased by 2,500. Go to new balance sheet, write down 13,000, 14,250. 14,250 over. And this 2,500 is written on the credit side of revaluation account. Write down both the things separate simultaneously. Next, furniture should be depreciated by 10%. Look at furniture once. 6,500. Depreciation means decrease in the value of asset. Go to revaluation account, debit. Okay. Now immediately go to the new balance sheet. 6,500 minus 10% over. Next, reserve for bad and doubtful debt should be provided at 10%. Yes. Go to revaluation account. Trade receivables 5500 into 10%, 550. Immediately go to balance sheet. Immediately go to balance sheet and do the same. Trade receivables minus doubtful debts. Next, the value of land and building should be enhanced by 20%. Land and building is 25,000. Enhance, increase. How much? 20% now, 5,000. 25,000 into 20%, 5,000. 5,000, take it to the revaluation account credit side. Immediately go to balance sheet. 25,000 plus 5,000, 30,000 rupees. Over. Next, the value of goodwill be fixed at 15,000 rupees. In the first one, they said 15,000 rupees capital. Here they said 15,000 rupees, 5,000 capital, 15,000 goodwill. This is total goodwill of the firm. Out of this, what is the share of Mr. Mystery? He has to bring that amount. General reserve will be transferred to the partner's capital account, whether they specify or not. We will distribute. What is the entry for distribution of general reserve? General reserve shows credit balance. General reserve account debit to partner's capital account. Who are the partners? Dalal, Banerjee and Malik. Next, new profit sharing ratio shall be Dalal 5 by 15 means 5 is to 5 is to 3 is to 2. When the new profit sharing ratio is given and old profit sharing ratio is also there, 2 is to 2 is to 1. Now you can calculate sacrificing ratio. Like after calculation of sacrificing ratio, out of 15,000, new partner should bring, and here the logic is there are 3 partners. Anyway, the last partner, Mystery, he is gaining 2 by 15. Sometimes the existing partners also may gain some share. In this problem, that is an important point. The existing partners may gain some share. They also should contribute goodwill. In this problem, goodwill is very, very important. Look at. The outstanding liabilities include 1,000 due to Mr. Sen, which has been paid by Mr. Dalal. This is another important adjustment. Actually, outstanding liability how much? 1,500. Out of that, 1,000 rupees due to Sen. Mr. Sen, he is a person. But it is paid by whom? Dalal. Dalal paid. Then Dalal capital account increase. Why? Because Dalal indirectly contributed capital of 1,000. Actually, outstanding liability is for the firm, not to Dalal, but Dalal paid. If Dalal recovers this amount from business, then okay. But Dalal is not taken this 1,000 rupees back. That's why Dalal capital account credit, revaluation account debit, or liability. Look at calculation of sacrificing ratio. Here, who are the sacrificing partners? Look at Dalal sacrifice, Banerjee sacrifice, Malik no gain, no loss, Mystery gain. Sometimes the one of the partner may also gain. Now Dalal, how much amount he has to bring? 15,000 into 2 by 15. He has to bring 2,000 rupees. And this 2,000 rupees is given to Dalal, Banerjee. Mystery should bring 2,000. This is given to Dalal and Banerjee. How? 1 by 1 is to 1 ratio. Means 1,000 rupees. 1,000 rupees. Clear? Look at the new balance sheet. Trade payables, no change. 12,850. Outstanding liabilities is a change. 1,000 rupees decrease, na? Yes, sir. So write down 500. And these capital accounts are taken from here. Partners capital accounts. Here partners capital accounts is prepared. One by one. If you think what is the entry for this and give postings into partners capital accounts. Ultimately, these are the closing capitals. And these capitals are taken to the balance sheet. After that, one by one asset look at. Land and building increase. Furniture decrease. Inventory compared to previous amount, inventory increase. Trade receivable decrease. Cash balance same. They have taken in bank. How much amount he contributed? Tell me. Already bank balance how much we have? 960. He contributed 5,000 rupees capital. So that 5,960. They did not mention whether goodwill is brought in cash or not. Assume the goodwill is not brought in cash. So the bank balance becomes 5,960. So as much as possible, you try to solve and come. Clear, students? That's it. This is admission of partners. try to solve the remaining problems in this manner. We meet again after 15 minutes. We try to complete retirement, death. In case of retirement and death, the important concept is joint life policy. Except this, remaining treatment is same. In case of retirement and death, joint life policy adjustment and how we have to settle retiring partner capital account or executors of deceased partner capital account. This we discuss after break. Is it clear? Yes. Hello students, am I audible? Okay. Yes. Hello. Hello. Yeah. So whenever suppose there are three partners, actually it's a voice disturbance. Okay. When there are three partners in a firm, one partner is retiring. One partner is retiring from the firm. Means he is leaving the organization. He is leaving the partnership firm. Then what are the adjustments we have to do in the books of accounts? Sir, when a partner is retired, then we distribute some sweets and we do some felicitation to him, all those things. No, we are not going to discuss all those things. We are going to discuss what is the accounting treatment when a partner is retired from the organization, when he becomes partner of the firm, when he contributes capital. Whenever he retiring from the organization, then whatever the amount due to him, we settle his account. Whatever the amount due to him, we finally calculate. Okay, Mr. Partner, Mr. Retiring Partner, this is the amount due to you. Take your capital and go. Leave. Is it clear? Yes. So that is what we are going to discuss here. First of all, when a partner is retired from the organization, then what are the various adjustments we have to do? In addition to the adjustments which we have done in case of admission of a partner, we do some extra two adjustments. What are those two adjustments? Observe carefully. First one, revaluation of assets and reassessment of liabilities as usual. But here the revaluation profit or loss is distributed to all partners including retiring partner. Including retiring partner. There in case of admission we distributed only to old partners, not a new partner. And here the same memorandum revaluation account concept also apply. Do you remember? That's why I said if you can understand the adjustments in case of admission, then the same adjustments may carry in retirement and death. Our task becomes very simple. Next step. So revaluation of assets and reassessment of liabilities tell me the profit or loss on revaluation is distributed to all partners in their old profit sharing ratio. Here the memorandum revaluation concept also comes. In case of memorandum revaluation account, part 1, profit or loss is distributed to all partners including retiring partner in their old profit sharing ratio. Part 2, in the part 1 if it is profit, part 2 it is loss. This is distributed to continuing partners. In case of admission, what we did, part 1 profit or loss is distributed to old partners in their old profit sharing ratio. In case of part 2, what did we did, part 1 profit or loss is distributed to all partners including new partner in their new profit sharing ratio. Here what we do, first part profit is distributed to all partners including retiring partner in their old profit sharing ratio. Part 2 profit or loss is distributed to continuing partner. Continuing partners means leave the retiring, eliminate the retiring partner share and continuing partners in their new profit sharing ratio. This is only the difference. Next one, distribution of reserves and accumulated profits. This is also same. In case of admission, we distributed reserves and accumulated profits to old partners in their old profit sharing ratio. But here we distribute to all partners in their new old profit sharing ratio. Sometimes what we can do is the share of